Hey everybody, we're going to talk about how banks work. So this is one of my favorite units, especially doing bank T-charts because I see that they're kind of like a puzzle and I really enjoy trying to solve them. And I hope that you enjoy this unit as much as I do. And if you're struggling with it, don't worry, we'll set up some time to work together next when we get back on campus. All right, so for starters, how banks work. If you wanted to open a bank yourself, you would need to raise a bunch of capital, a lot of money. And in order to do that, you would sell stock in your bank. So you'll have, say, $1 million that you'll put in, and then you'll sell stock to several other people who trust you. You'll pull that together. That'll give you a good base of money to start lending and start earning interest on. Then you'll open to your customers and you'll receive deposits from customers. Finally, you'll keep some of those deposits back and lend out the remainder so that your bank can make money off that interest. So you'll pay the customers a little bit for their deposits and savings, and you might even charge them a little bit for their account in checking to maintain that account. And then you'll lend money out at a higher interest rate, and that's where you see your profit. Now, keep in mind that bank stock typically costs about $10,000 a share. You're not going to walk into a bank and accidentally buy some stock. So don't fret over that. If you're going to deposit money in the bank, it's going to your savings account, and bank stock is something that you would have to really work a lot harder to purchase. So banks pay you a percentage interest for putting your money there. And I looked today, and BB&T, the largest national branch we have in our area, pays at 0.03%. So that's 3 cents on the $100 for your savings account. It's a very, very low amount. But you know that your money's safe, and we'll discuss that here further in just a minute. Now, when you think about the hard earned savings that you've just put in the bank, I just put my paycheck in the bank a couple weeks ago. How much of your money do you think that the bank should be allowed to lend out to customers, people who may or may not pay back their loan? So you'll be lending for things like houses and new cars and used cars and vacations and college funds and all sorts of things that people may or may not pay back. I personally don't mind if the bank lends out your money, but I don't really want them lending out mine. And if they lend out too much and I show up at the bank and they don't have my money, it's going to be a big problem. But I have good news for you. The Federal Reserve requires that its member banks keep 10% in reserve. So your money is going to need to be in reserve at the Fed, and they'll keep 10% of that back. So if you put $100 in the bank, 10 of those dollars will remain in reserve, and that's 10% of demand deposits, things that you could go in and ask for immediately. So 10% of your checking account. Your money is also insured up to $250,000 per Social Security number. So my joint married account is insured up to $500,000 by the FDIC. So if you have more than $250,000 or more than $500,000, you could split it among different banks. But I will note that while everyday banking practice for most of us is not a big deal, there are certain organizations that could really lose money if a bank failed. For example, a local government who's about to do payroll. And when some banks failed in 2009 with the big recession we saw then, some local governments lost money because they didn't, as a habit, keep that much money in, but during times right before payroll or right before a big project, they might have that kind of money. Think about a business that's about to buy a bunch of materials to do a big building project. They might have that kind of cash on hand and ready to write the check, and they could lose some money if a bank went under. But for most people, most consumers, most businesses, $250,000 is plenty, and the FDIC doubled it during the last recession to ease worries of the general public. Bank failures. So if you will, click and watch these videos and the video at the top, and then come back to this homepage. Hope you enjoyed the video at the top. And I remember when Security Bank closed. It was a bank in our region, and it closed abruptly due to the recession, and the sheriff's department was out there. And what happens is they come in on a Friday night. They hopefully have already pre-sold the bank to a willing buyer, and they then take over the bank. The good news for most consumers most of the time, nothing changes. Your deposits are right there. They might eventually close a branch, but you can get your money out. You can still have access to your money. There were some banks that all of the branches closed entirely without a buyer, and it took several months for people to get their money back, but the money was ultimately returned. All of the insured dollars were protected. And because it's backed by the full faith and credit of the United States government, that means that if the FDIC doesn't have the money, the Treasury will give them the money. In the meantime, just like other insurers, they'll raise premiums on the people who owe. Now, if you'll get ready to click on the second link, and you can even leave my video playing here in the background. If you'll look at this failed bank list, what I want you to do is count how many banks have failed in 2019. How about in 2018? How about 2017? And I want you to keep scrolling back and look at the number of pages you have of bank failures as a result of the 2009 recession. You'll see a big spike in 2010 and 2011. And then if you go back before 2009, you'll see that very, very few banks had failed. So one of the things that we saw were some big weaknesses in our banks as a result of the 2009 recession. Banks had made a lot of mortgage loans that were not paid back. And historically, people have always paid their mortgage. You want a roof over your head, but they did not in this case. And so that was a very unusual situation. Finally, if you'll go down and click on the bottom bank, you can see bank searches. So you can look up your bank and see how it has performed on various stress tests required by the Federal Reserve. You can look up United Bank, although it's a little bit challenging to find it because there's lots of banks across the country named United Bank. Credit unions are subject to similar but slightly different regulations, so you won't see them here on the bank rating search, or you won't see that they're insured by the FDIC. Credit unions are insured by the NCUA, which is the National Credit Union Association, and they're still insured by the same amount, so they do stay up with their peers in banking. Credit unions, unlike banks, are not for profit, so the money goes back to the lender, to the members. And those of you that have bank accounts at our local credit union may have noticed that our credit union does that by a little Christmas bonus. They also do it by having some products that pay really high rates for savings and lower loan rates. All right, but banks and credit unions both actually create money in the economy, which is a little interesting and maybe a little scary. And they create money by lending out your savings and checking. So we're about to look at a money multiplier. You'll remember we've looked at a spending multiplier and a taxing multiplier, by which government spending gets multiplied through additional rounds of spending throughout the economy. This is going to be very, very similar, but it's going to be through money that is given in loans by banks. So here is a table of the money multiplier. So if Whitney deposits $100,000 in the bank, and because the Federal Reserve ratio is $90,000, the bank will then lend out $90,000 of her money. Now, they're not required to lend out $90,000, but let's assume that they're loaning at the max because we're in Econ 101. We don't want to make it too difficult. So then Whitney uses, or the person that borrows that money goes to Tristan's Teslas and buys a $90,000 Tesla. That's not hard to do. So Tristan then takes that money that came into his business and deposits it in the bank. So the bank then will create a loan for $81,000 to another business that is Bria's Bread. So Bria takes that money to buy mixers and things, and as that happens, that money that she purchased goes to companies that ultimately deposited in the bank. So it might be a customer account, it might be a corporate account. Well, they can loan out $72,900 of that with the Federal Reserve ratio. And so that money gets loaned out to Joshua's Jam, which then gets deposited in the bank when he purchases what he wants for his jam company. That leads to a next round of lending, Houston's Huts. You're welcome for the alliterations here. All of these loans go out, and you see how the money shrinks and shrinks, but this $100,000 could potentially create $100,000 plus $90,000 plus $81,000 plus $72,000 and so on of money in the economy. Now, where this gets tricky is Whitney, even though this money's been lent out, Whitney at any time can come and ask for her $100,000 back. But because they've kept back some from Whitney's account and Tristan's account and Bria's account and Joshua's account, they will have the money to give that to her. And further, that is backed by the full faith and credit of the United States government. All right. We are now starting one of my favorite sections, T accounts. Bank T accounts are divided into assets and liabilities. So this is a type of accounting where every entry on the left-hand side has a corresponding interest on the right-hand side. This is called double entry accounting. And if you take a finance or accounting course later in your career, or maybe you've taken one at the high school, you have seen this type of accounting. We're going to talk through it step by step. We do a much more simplified version of what an accountant would see if they were looking at an actual bank balance sheet, and this is also called a balance sheet. So assets are things that you have. So for consumers, things that you have would be things like savings, your home, your car, if you own those things outright. Liabilities are things that you owe. So for consumers, again, that would be things like your car payment, your home payment, your student loans. Banks, it's going to be flipped because banks, of course, accept your liabilities and hold your assets. So this is a T account, and on the left-hand side, you see the assets for the banks. On the right-hand side, you see the liabilities. We'll go through these one by one. So for starters, your demand deposits. These are customer deposits, so what you put in your checking account. And they're considered a liability for the bank because the bank had better have it when you show up and ask for it. The good news is when we talk about the Federal Reserve, we'll discuss how banks can actually borrow money from the Fed if, for example, they run out of money to meet demand deposit requirements on a given day. Owner's equity is stock that owners have in a bank. So if when the bank started, they sold stock to raise money, which is very common, that money would go back to those stockholders if the bank were to liquidate. All right. On the left-hand side are required and excess reserves. We discussed this a little bit earlier, but if I put $100,000 in the bank is required by the Federal Reserve to keep back a percentage of that. Right now it is 10%, which makes the math easy. So $10,000 of that $100,000 would be required to keep in an account at the Federal Reserve that the bank can't loan out. They may also put additional monies in that account, and that would be excess reserves. If you see an account that says bank reserves, you might have to actually break it down and say what part of that is required and what part is the bank actually just opting in to keep as excess. In addition, the bank's assets are customer loans. So while the bank keeps what it owes you, the bank wants what you owe it and counts that as an asset. So when you show up and pay the bank, that is considered an asset for the bank. So if I have a loan of $10,000 on my car, the customer loan would be an asset for the bank. Government securities. These are treasury securities the bank has purchased. So just like you put your money in savings account to have a low interest option that's very, very safe and insured, the bank does that, but rather than a savings account, they purchase government bonds. Government bonds typically carry a very low interest rate, and they're not insured, but the only way that they wouldn't pay back it is if our government defaulted on their loans, which means our currency wouldn't be very valuable anyway, and the bank's other assets and liabilities wouldn't have a lot of value. So this is a very, very safe way for banks to sit money aside. It's safer than a loan to me, you, or a business, but it doesn't pay nearly as well. And then, of course, building and fixtures. The building and other physical capital are powerful places for the bank to make money, and they can sell that off and liquidate that if needed or if the bank were to close. On this T-chart, assets must equal liabilities. So everything in the left-hand column, if you add it together, must equal everything in the right-hand column. And that's a nice, neat way to do double entry accounting. Another point that was made a little bit earlier, you may or may not see sometimes things like building and fixtures or owner's equity or reserves on T-charts. These are oversimplifications, and sometimes they're even more streamlined for a test question.
I put everything that could possibly show up here in my example so that you can see and will be prepared for any possible outcome. Again, if you were to see an actual banking scenario, you would see more detailed breakdowns of these. So here, if the assets must equal the liabilities, we have $150,000 worth of liabilities over here. We've got to spread that among our assets. With a required reserve ratio of 10%, the first place we're going to put information is going to be in our required reserve. So that would be $10,000 of demand or checkable deposits. Then we would need to give you some of this data. So you need to know how much was out in customer loans, how much was out in government securities, and how much was in building and fixtures. So if we fill all that in, you can do the math to get the remainder of the demand deposits. If we add all this together, you'll come up with $110,000, which means that our excess reserves must be $40,000. So that's sort of where the puzzle comes in. You'll be asked to find information and find the remainder and fill in the blanks. So how much can this bank lend? So if you take a look here, much of this information is already tied up in required reserves, in customer loans, in government securities, and building and fixtures. So this bank can lend $40,000, the amount of its excess reserves. It also could, of course, over time liquidate bonds and securities and lend that information out. But just on a random Tuesday, if this was the balance sheet, they could lend $40,000. But things change quickly because deposits and lending and withdrawals are happening. One other thing to note is that the bank, at the end of each business day, it rebalances its T account and figures out what it can do for the next day. So it can always borrow from the Fed if it goes over, and we'll talk about that in more depth. And withdraw $60,000. So I'm going to walk you through this step by step. And one of the things I did was just put a running total up here by the assets and liabilities chart. That is not a typical part of the chart, but I wanted you to be able to see it really directly. So I walk in and I ask for $60,000 out of my demand deposit account. Just a couple things about banking practice that you might want to know. You can at any time go get your money out of the bank, but I can't walk in on a random Tuesday and ask for $60,000 worth of tens and expect to get it. So you may not be able to get your money in cash, but you can always go get your money from the bank in the form of a cashier's check or a wire transfer to another bank. If you did for some reason want an unusual amount of cash, you would need to request that. Banks keep a lot of cash on hand. Think about cash heavy businesses like vending machine companies that are going to need that, but they're used to that as part of their day-to-day business. So they're not going to give or fund an unusual out of the blue customer request for cash because they're not prepared for it and they want to keep it for typically their larger customers. If you're big enough, I suppose they would find a way to make it work. But for most of us, if you do want a large cash withdrawal, you need to ask ahead of time. Otherwise, be prepared to get a cashier's check or make a wire transfer. All right, so I walk in and want to take $60,000 out. And the first thing that's going to happen is it's going to come out of demand deposits. So they'll hand me that $60,000 in a cashier's check or make a wire transfer to whomever I please. And then the next step is the behind the scenes part where the bank rebalances their assets to fit their new $90,000 liabilities. So you see here, I struck through the 100,000, changed that to 40. Now we have $90,000 total. Keeping a running total like this when you're solving these problems is a great idea. You can just write it out to the side or in the margin of your paper. So over here on the assets, we've got to change this $150,000 to $90,000 because this is double entry accounting. It's called a balance sheet. The assets must balance, must equal the liabilities. So my first step, take a look at your asset sheet and notice that you cannot change some of these numbers. Building and fixtures, for example. You can't just sell off desks in the bank if you come up short or need to make money. So that's something that can't change on the daily basis. Bonds, typically bond orders are going to be placed at close of day or day before. For most banks, they don't get actively involved in the bond market. Your big banks, Bank of America, Wells Fargo might, But in terms of liquidity, these bonds are not going to pay off this liability. Customer loans, I can't come in and ask you to pay off your car loan in full because I came up short for cash on a random Tuesday. So customer loans are not going to change in the short term. So the things I can change are my required and excess reserves. You can probably see we're going to have a problem, and we'll talk about what we can do there. All right, so our assets, changing my required reserves, I have $40,000. I only need to keep 10% of that in required reserves. So I'll change that required reserves to $4,000. That brings $6,000 available to drop the assets and get a little closer. My next step is going to be my excess reserves. This is money that I could loan out. Well, I had to just pay a customer, so I will adjust that money that I could loan out down to zero. That brings me down to $104,000. I'm now $14,000 above, and it's close of day at my bank. There's nothing else I can do. But banks commonly borrow from other banks. So you would get a loan from another bank or the Fed right here, and that loan would be $14,000. So that will lead to a balance of my assets and liabilities. This brings my liabilities up to a total of $104,000 and my assets up to $104,000. So if you add everything up in both columns, you'll get $104,000, and that means that we now have a bank balance sheet that does balance. We're going to practice with that, but if a bank does go over for the day, it can borrow from another bank or the Fed. I did a more complex example here, but typically you would just balance your reserve ratio and your excess reserves to make sure that both sides balance. And you do, though, need to know that if a bank goes over, they can borrow from another bank or the Fed. We're going to practice with this on a T-chart.